Hey, what's up, ICT traders? Welcome back to the channel. And those of you who are trading synthetic indices, this video is specifically for you. Now, I've gotten a lot of requests from synthetic traders. Those of you who don't have access to trade synthetic indices on Derif.com or maybe other platforms, this may not benefit you that much. But if you're trading synthetics, this is going to be very, very handy for you. So 5 ICT concepts that works perfectly on synthetics. Synthetic indices are very nice to trade, especially for those of you who have that much emotional stability. But I don't advise anybody who does not have much emotional stability in the foreign exchange market to trade synthetics, because synthetics are basically very fast in price action most of the time. And if you don't have that ability to control yourself, you may be, emotionally driven to trade this kind of assets wrongly. So let's go into checking 5 ICT concepts that works perfectly with synthetic indices. Number 1, if I should mention them right here, is mitigation block. All right, mitigation block is a very, very powerful institutional reference point that you should always look for when you are trading synthetic indices. It is a ICT concept that you want to check most of the time. Let me make it smaller so I can do that easily. All right, so let's give it a number. Number 1 is the mitigation block. What exactly is mitigation block? A lot of the time I used to tell people these things are easy to identify. Let me just sketch a mitigation block for you so you can see what a mitigation block is on a simple term. Let me go to path where it is, arrow, trend line. Let me check path, where it is. Okay, this is it. Let me select it as my favorite. So let me show you what a mitigation block is. Mitigation block is basically a failed order block. All right, if you have price action like this, going up, coming down, going up, coming down. Now if price comes down like this, right, now in this kind of price action, it's where we have gotten the concept of order block and the rest of the things. If I pick my tool right here, what do you think is here at the end of this price action? Here, the last sell candle in this bullish scenario, this particular candlestick that price printed lastly here before going up and creating this break of structure to the upside is what we basically call a bullish order block, right? So price normally comes like this and, go up after hitting this bullish order block. Now, in a situation when we have this particular order block printing up like that, it will now create a new order block here, which price will normally come down to. All right, price will normally come down to right here. Let me show you that properly. So we have a new bullish order block here that price is supposed to come down and hit to go up. Now price coming right here, it will now go up again. I just want to show you how a mitigation block forms. So now if price decides to go up like that and then had a failure swing, not able to break above this guy, coming down right here, all right, what are you expecting to see this thing do? As okay, let me get it correctly right here. So if you see your bullish order block here, right here, you are expecting price to reject it here, right here, and then push it up to the upside right here. All right, but if this bullish order block fell to push price up and then you suddenly see price crashing lower, all right, forming this kind of an M formation, we call it a failure swing. I'm taking much time explaining mitigation block. I guess you should know this anyway. You can check my YouTube channel. Creating a shifting market structure right here at this point. Let me see if I can get it correctly. This is where your shifting market structure is, right here at this exact point. So if price creates that shifting market structure and then crashing lower, so this guy that was supposed to be a bullish order block becomes a bearish mitigation block. So price is supposed to touch it and then crash lower. So this is your bearish mitigation block. Just like this one has formed, if you're doing it in the opposite way, you would have a bullish mitigation block. So this is a bearish mitigation block because price is being pushed downward after touching it. So this is your bearish mitigation block. So let's check mitigation block on our chart first of all, and then see how we can identify them easily. So now coming back to our charts, let me show you a mitigation block. I told you that the bearish formed that, M formation like this, a failure swing crashing, creating a shifting structure here, and then we want to see it from here, push price downward. That is your bearish mitigation block. So this is one I'm seeing right here. Basically, here you see price came right here, this low, pushing up there, coming here, going up to that level. Does this looks like a mitigation block? Let me show you. You see, a mitigation block has a failure swing. This is the failure swing. So right here, we have the last bullish candle that price printed as our bullish mitigation block. Even though this was a bearish mitigation block I just sketched, this is a bullish mitigation block. So if price is coming right there, that should be your entry mitigation block. All right, so that should be your entry. A bullish mitigation block is spotted right there. All right, I wish I could see a bearish mitigation block and then show you an example. Then this was a bullish mitigation block, a very perfect one. Every time you see them, okay, there is a bearish mitigation block here, but then price didn't reach it right here. This is it, the last sell candle. I was expecting price to come back right up to that point before crashing. So that is a mitigation block. You can check on your chart. Don't just take my words for that, guys. Check it on your chart and see if these things are true. Check and see if what I'm saying is true. All right, look at one right here. Even though you will not be able to see this very clearly, look at this. Price came right down here, pushed up, crashing here, and then shifting structure, and this guy pushed right into the mitigation block. All right, right into the mitigation block here. This is it, right into the mitigation block. In fact, I am not seeing it clearly. This is what it's supposed to be. Look at this. Price shifting structure right above here, because the body of the candle actually closed above this guy with just a little push, and this guy pushing, even though it's not that very clear, but a mitigation block is spotted right there. A mitigation block here, am I seeing it correctly? Mitigation block pushing up, coming, going up. Okay, this one didn't reach our mitigation block, but it has formed a mitigation block formation right here. Such kind of price actions do happen. All right, so this is it, mitigation block, a W formation, a bullish mitigation block. This is not a mitigation block. I wish I can show you more and more examples, but then okay, this is a mitigation block here. This entire price action, we'll consider it mitigation block, right? You see price coming into it, and then it's sold right down here. All right, so everything I'm showing you, you must not trade them without checking your order flow. Your order flow must be correct. If you're bullish, you must use bullish momentum to trade. I'm just showing you the institutional reference points that are working on ICT concept. This entire movement is a mitigation block, guys. This guy, this entire movement, failure swing, pushed up, price coming right into it, and boom. So that is a mitigation block formation. Another mitigation block formation right here spotted. A lot of them here, pushing down, pushing up. It went all the way up there and then came back into it and then took up from there. So a lot of them are there on your chart for synthetic. It's just because some of you are just in hurry to just trade. So this is it, the last, this guy. Notice how price respects these guys perfectly. This is a breaker, all right, and that is the second thing I will go to. So the second thing, I think I've shown you enough. I don't need to show more than that. Okay, so the second thing is a breaker block. All right, the second thing is a breaker block. A breaker block. So what is a breaker? The simple difference between a mitigation block and a breaker is that a breaker will have to sweep liquidity. Both of them are in this pattern, M formation. Remember, in the mitigation block, we did not have this guy pushing above the left hand side. This is a bearish breaker block. All right, so notice how price now pushed above here, creating this area. So this is an attempt to sweep all the buy stops before crashing. So all of them are right here. This is a bearish one because price is expected to come back right into this and crash again. Are you seeing these guys? So if we are having this formation, what you need is the same thing for the downside also. Price coming, having this, clearing liquidity, shifting structure. So for a breaker and a mitigation block to be valid, it must create a shifting structure. This shifting structure is highly important and it must be with the body of the candle. All right, I think this is important. So let's take a look at this right here. So price came, pushed, creating this low right here. The last sell candle is now your bearish breaker. Price came all the way right here and then came back and touched that area. So notice how price respected that guy. I think the last sell candle is this area. Let's see it, this guy. All right, so notice how price came back right into it. The last sell candle is here. So that is your breaker and it becomes your entry point. You know, it respects distance so powerfully. It respects distance. I'm just showing you without the order flow, but you can do the order flow also by yourself. This is a mitigation block, but then I am not seeing price, touching it, even though price tried to go up to that area. I'm just looking at it from that perspective. This also is a mitigation block. Notice how price did it. This is lower than this, so it's a bullish mitigation block. I'm just showing you some of them right there. So this is a breaker right here. Price had this, came here, shift structure. The last buy candle becomes your breaker. Notice how price touched it and then it took up from there. Now these things are very, very pertinent for you to take notice of, and then don't use them without understanding your order flow. So this is a bearish breaker right here. Price pushed, creating this, breaking above to sweep liquidity. Price came all the way right there before crashing downward. So I am seeing a lot of them time and again and again and again. All right, so every time I come close to my chart, I am seeing them. Now it's simply because of some of you guys that say ICT concept doesn't work with synthetic and all those stuff. It works, guys. It works perfectly. And I have used them for trading time and again and again. A lot of them, a breaker, all those ones. And you can see them time and again and again. So let's go back to the next one, which is an order block. All right, an order block. I think I've seen a breaker somewhere around here that price used. But anyway, I think it's enough. So let me show you the next one. A fair value gap is the next one. The third point is a fair value gap. Let's see where price has used a fair value gap for price entry. So what exactly is a fair value gap? Now, a fair value gap in simple terms is simply an imbalance, and you're going to see this imbalance in price action. Let me show you. Okay. So for you to identify a fair value gap, you need at least 3 candlesticks. All right, 3 candlesticks. The color of the candle does not matter. These 3 candlesticks must print in the same direction, but the candle color does not matter. So look at this. You have 1, 2, 3. Let's assume this is our candlesticks. Number 1, number 2, number 3. Let me name them. 1, 2, 3. All right. So in creating a fair value gap, all you need is the low of this candle and the high of this particular candle. All right. So the second candle is of no use for you when it comes to identifying a fair value gap. So this second candle does not have to do anything. It only has to have the gap in between it. So between the low of this first candle and the high of the third candle is where the gap is. If there is gap in between. Now notice this one. Look at this. Very close to it. Can you see? This is the low of this, right? If I say 1, 2, 3, you can see this particular candle, the low is here, and then this one, the high is there. So here, right here, and the high of this one. Is there any gap between them? There is no gap in between them because they have traded through each other. There is no gap between them. So that is not a fair value gap. So a fair value gap is simply that thing I just showed you. So let me show you a fair value gap for an entry on synthetics. All right, very importantly, very importantly, look at this. Price gave you a very nice fair value gap entry, break of structure, All right. Price creating this one. This is a fair value gap right here. Let me show you the high of this candle. And let's see, let me just, okay. And the low of this candle. Can you see a gap in between it? But then most of the time when you see this very big fair value gap, price will push into the middle of that fair value gap. It is called the consequent encroachment. These are no new things on ICT. So notice how price came back into it. This is the same thing I'm expecting price to do here. Come back to this one and this one. This is a fair value gap. Price is supposed to trade into it and then, you know, pushed up from there. So a fair value gap is very important. Let me see more fair value gaps in a very, very nice and a decent price action. I wish I can see a very, okay, look at this, a fair value gap right here. Price came. So breakout structure, fair value gaps are very strong when you're dealing with a trending market, you see, right there. And this is the fair value gap. Notice how price completely filled it right there. So this is a fair value gap. So notice how price printed into it before going up. All right. So those are your fair value gaps, guys. I hope this is understandable. Next one is order blocks. All right. So what exactly is an order block? All right. An order block is, the word is basically a compound word. Two words are there: order and block. All right. Order and block. Order is simply your open interest. You know, blocks are large transactions in finance. Large transactions. Those transactions can only be done by smart money. All right. So these things can be seen by the kind of price action that happens there. Order blocks are capable of turning price direction, giving it a new direction, or you can see a massive price reaction from those areas. All right. So look at this. Price was moving up, moving up. Some of you know these things. I don't want to go back into that. So this guy, this last buy candle becomes an order block. Even though I prefer to mark my order block, including the wick here, this becomes an area. So order block is basically an area because I've come up with a way of filtering some of the things in the lower time frame. So this one from here to the wick right here becomes the order block because this guy has actually swept liquidity above here. So it's very important. Price can push into it and you're going to see some reaction. So basically those are areas that are capable of creating this. So after doing that, price have done things like, you know, creating a shifting structure, leaving a fair value gap right there. These are things you look out for in a valid order block. You see, a fair value gap close to it, you know, creating a shifting structure right at that point. All those things are very, very important. All right. So the next thing I think is a liquidity void. A liquidity void is when you see price quickly move in a direction just like this without getting any opposition. Price has high tendency of taking time to balance it completely. When you see this sudden move up, price will balance it correctly. So you will see this happen time and again in your charts, just like this one. Look at this. Boom. Price doesn't move forever. Balance comes in. So liquidity void is that one. It's also an imbalance in price action. And I think right here, I'm seeing something like a breaker formation here. The breaker we talked about, and you see, I use this a lot when I'm taking trades. So let me say this again as a disclaimer, guys. I am not giving you a kind of a holy grail or just giving you some perfect entry scenarios. I'm just showing you ICT concepts that can work or that are working with synthetics. And if you can filter it with the knowledge you have already on my YouTube channel, you can do a lot with ICT concept. It's pretty much easy and straightforward to use it. All right. I hope this helps you somewhere. And if you have any question, let me know in the comments, guys. I'll be right there to answer your questions, and I'll be very, very glad to respond to you personally. All right. A breaker block formation is here. You see price sweeping liquidity above this guy, leaving you with this one. You see right here. We'll look for the last sell candle here. So that is your entry for the sell. Right, where are you selling to? A fair value gap is here, my friend. So your target should be also considerate. All right. So the overall flow is bullish. So if you are selling, you should be careful. So here is your target. You take it out and leave. That's how I take the trades, guys. And in synthetic, 1:1 is very okay. 1:1 is okay. You don't have to risk so much. 1:1 is okay for you. Take and leave. Take and leave. All right. All right, guys. Thank you, guys. See you in another video.